for our feature presentation. Tonight, we have a very special guest with us who happens to be an MREA member, Mr. Frank Mulata. Frank is one of the most experienced people in our group. He has been dealing with real estate finance for years. He also is involved in doing all kinds of development deals. His expertise is financing, so you're going to learn a lot. And private financing is going to explode. So especially for investors, even though they're doing now 30-year mortgages, you think, though, that might mean that private investing will kind of be thrown by the wayside. Absolutely not. Think about it. Somebody has a property they're going to sell, and they're thinking about putting it in a bank. What is the bank paying right now? So, the opportunity is there for private financing. And Frank, all yours, sir.
All right. Thank you. And welcome everybody to the presentation. So I'm going to share my screen. Let's see. Share screen and right. So I think I'm all set. All right. And thank you, Dave, for the introduction. I'm just going to move this over. All right. So so thank you all for the call to join. And what we're going to discuss is about private lending. And it's not about private lending. It's really how to increase your chances of getting private lending funding on your next project. And so I'm going to explain based on a private lender's point of view how to increase those chances. And like what Dave said, private lending is going to be big, more, and you want to be at the cusp and be able to, if you have deals, you want to actually have private lending as maybe one of your financing options, and it's really key. So just about me a little bit. Again, I'm a realtor, I'm a real estate investor and entrepreneur, and I spent many years in the corporate real estate world. I had an education, actually. I have a master's degree from NYU in real estate development and investment. And I started working my way into with developers, and the market went bust, and everything we built, we ended up managing, and I'm getting into commercial property management with that, and which is kind of recession proof a little bit, but I ended up getting into so property management. I did asset management for, again, large institutional companies, where we used to actually always look at the time in the market, whether we want to sell it, reposition the asset, or buy. Also, I worked in facilities management as well for the corporate companies like Bank of America, Merrill Lynch, AIG, and I handled throughout my career about $300 million budgets total. I am a private money lender. I've been doing it for the past 3 years. I lent over $2 million in loans. And exactly what, like Dave said, is that people like me who traditionally had money in the stock market or mutual funds or bonds or in the bank, we looked at, I'm 55 years old, and I looked at what I accumulated in life, and I'm like, oh my God, my 401k at the time and my IRAs were growing because I was contributing into them. But if I wasn't contributing into them, the returns after all the fees I was paying was lackluster. And I'm like, this is crazy. And actually, when I was working in the corporate field, I was working at for the Weena Malcolm family, and we were flipping commercial space. And I was intrigued by, because I sit at the investor meetings, and they used to pay the investors 6%. And you're like, and I was intrigued by it because I saw that 6% was backed by real estate, and they had no risk, and they were getting these high returns. Versus if you did low risk in a bank or bonds, you're getting minimal return of like 1%, 1.5%, or less than that. So that's how I was starting to be intrigued. And then myself and my business partner, who we came from the corporate side, we ended up getting involved in real estate. We ended up opening up Fine Home Solutions, which is a real estate investment company. And so we did our own investing. And then from that, we actually started a contracting business to support our projects and then also other investor projects. And And then from there, that's how we were loaning. We started, people came our way, and deals were presented to us. And then it was natural, by myself and also my business partner, we ended up starting to loan independently of each other on different deals. And so that is a little bit about a bit about my background. And real estate is exciting for me. I know it well, and that's why I feel comfortable investing in it. And one of the things that I feel really good about with this is that I can, when I do my private lending, I can see what I'm investing in, versus I used to be approached in the city a lot of times by other places that I didn't know where my money was going to be invested into. God forbid things went south. I don't know how to claim or get my money back. But in the way I'm doing this now, it's very attractive to me, and to link up with people that actually present these opportunities to me. So generally, and also, this is going to be interactive type discussion. So if anyone has any questions, please, you can interrupt and say, hey, can you clarify that, or could you elaborate on that? I'm here to answer any of your questions, to make you present yourselves in the best way possible to people like me. So,
Right, just so you know, I have people going into chat to ask questions. So every once in a while, when you're ready, you let me know, and I'll read you what questions we have.
Okay, perfect. All right. So the biggest thing is, what is private lending? And to make it simple, it's all it is when someone has they're lending their capital, like their money, like I'm lending my money to other investors, or professionally managed real estate funds. That'd be like a syndication. And I wanted to have secured that money secured by a mortgage against the real estate. And in the past, again, financing from a lot of investors, it traditionally comes from banks, insurance companies, pension funds, etc. But now there's a whole host of private lending, and that is becoming more mainstream with people. And it's a good thing for you guys that are looking to get capital. So how is it different from the other forms of financing? And the biggest thing is that it is it's not regulated. And because it's not regulated, that makes it less cumbersome to actually have these deals put together. So, and that's the big thing. So the banks, mortgage companies, credit card companies, and other conventional sources of financing, they're regulated. And with that regulation, it comes applications and the paperwork and the fees, because someone has to look through that. And so what you're saving for is, normally there's, again, there's less fees when you have private lend, because you don't have all those administrative costs. There's no origination fees. Generally, sometimes there's no appraisals. It's not required. It depends on the private lender. Like myself, sometimes I require an appraisal, sometimes I don't. There's or inspection fees. Whenever you actually borrow funds, a lot of times you're going to have to pay for that appraisal to make sure that the property is incrementally being increased by the improvements you're doing in order for their loan to be covered, so they can give you the funds. So you're paying an appraisal and you're paying that inspector to go out. Again, with a private lender, you're not going to have that. Generally, it's going to be in-person viewing or FaceTime viewing of the progress of the work that's being done, and then when it's shown, then you tell the attorney, or you may release it yourself and release those funds. There's also usually no or less points. I personally, I haven't really charged points. Once in a blue moon I do, but it depends on the deal. But generally I don't. And that's what other lenders are. And also, I don't look at, or people don't look at your credit score. And don't rely on it, because I look at the project itself, and other lenders do the same thing. I don't really care what your score is. I just want to know, is my funds secured in that piece of real estate? Because if for some reason you can't pay me, you probably don't have much in the bank anyway, so there's nothing to go after. So your score may be good at the point, but when I have to come after, you're not there, it's not there. So I want to look at the asset. So that's another thing, because a lot of times people that are investors, especially full-time investors, sometimes, or because you're not working sometimes in corporate America, and you're not going to have you can't prove you're showing all this income. So a lot of times, sometimes your credit could be dinged a little bit because of that too. Or you had some projects that weren't that successful in the past, and so, but I don't look for that. And also, the other big difference is you can get the financing so much faster, and you can act quickly, because a lot of times you look at these deals, you say I can close in 2 weeks or 3 weeks, and with private lenders, they can get that money to you quick as long as you provide them what they're looking for. And that's the art of it. And so that's a little bit how it's different from other forms of financing. And if there's, Dave, any questions on that, we can go to the next.
No, we have a question, but the one I have, I think we ought to wait on.
Okay.
To make more sense.
All right. So the value of private lending for borrowers. So for the borrower, again, for you guys is, and also that and just to let you guys know too, I have borrowed money as well too. I lend out, and there's a few times I do borrow. And the reason why I was borrowing is because I'm just trying to establish relationships with people, and also wanted to expand, because I don't want to always use my money with different things. So, but a lot of times banks are just not fast enough, and that's why you want to have you want to have the private lending in your arsenal. Private lenders, they can act quick. When you don't want to be personally guaranteeing the loan, that's a thing, especially if you have a lot of partners. Sometimes I've done deals where there's 2 or 3 people that are, or more actually, borrowing the money, and they're like, who's going to be personally guaranteeing it? Is it going to be everyone, or one person, 2 people? And a lot of times for me, I don't care about that, because by the time if you can't afford the property, you're probably tapping out of everything you have. So there's nothing much for someone to go after. So why bother? So I don't look for that. It's nice to have, but I don't really put much value to it. Again, I'm speaking generally, for a lot of other private lenders feel the same way, but that's something that that's a big value for borrowers. When you don't have sufficient reportable income, actually, I just mentioned from the last slide, that's a big thing, especially self-employed. A lot of times you're trying to avoid taxes, and there's a lot of write-offs, and so your income may not be as healthy as it would be if you were working like a W-2 job. And so sometimes, or you have a lot of properties, and then how many, and your income is not going to support at least all those different properties, because they're all on different cash flows. But generally, sometimes the income, again, I don't care about that. With your income, I'm looking at the deal and making sure the deal is self-sufficient, and that the deal could support itself, and that you could. At least I would want to, and I'll go into later down the line about what I would be looking for is, like I call it, skin in the game. So, and that's something that would be important. But income, I don't really care. And again, and then about your credit score. So that's the big value for, again, borrowers for using private lenders. And again, private lending too, it's just one source of financing. You should always have something lined up for a traditional bank, some line of credits in different places. So it's very important to have that all lined up, because every deal is going to, when you put the deal together and you analyze it, there's going to be benefits for different sources of financing. So, but if you want something quick, short term, gap funding, private lending is a great value add. All right, so just move some of these things around. You guys don't see it, but I have a lot of different things on my screen that blocks my own presentation, so I gotta move it around. So how to increase your chances to get private loan financing. So pretty much, yeah, how are we gonna increase it? And that's gonna be unique in every way, but you have to show the people, show them what you're made of, show them what you know, impress them, because if you look like a novice or you don't know what you're doing, they're going to be nervous to be lending you money. They're not going to feel confident. If you're not, and also because you have to proceed, you have to give them at least, you want to show that there's decrease in the investment risk, because like there's a lot of deals to invest. A lot of people ask, "Hey, I need money," and if you appear amateuristic or you're not really, if you're not guiding in this right way, then it may be a turnoff to some people, and they'll just say, you know what, maybe in the future, but not now. But it's good to always keep them involved. But you have to show them what you're doing, so that's what we learn about it and be cognizant of what their needs are. So my thing is, if someone's going to show me, present a deal, I want to see, the biggest thing is prepare a full, complete deal analyzer. I want to see everything from the purchase price, the rehab cost, the carrying cost, the financing costs. I want to see the transactional costs in there as well. I want to see what you're going to be making in the deal. I want to make sure you want to do it, and also making sure that, so I want to see all of that. And in the deal, and as opposed to, and this is where it's different from other types of financing. Sometimes, well, I'm going to say, this is something that you don't want to have the lender figure it out for you if this is a good deal, because I'm not going to do it. I'm going to say, oh, thanks for showing it to me, but I'm not going to figure it out for you. You have to figure it out. And if I have to figure it out, I'm not going to be lending you money. It doesn't give me the warms and fuzzy. And a lot of people talk, and they talk to me, but they don't put it in writing. Everything sounds good, but I want to see it in writing. So yeah, it may spark my interest, but then I expect to see something quickly. So prepare a full deal analyzer, really critical. And that deal analyzer, that would really show just the project. It shows who you are, what your experience is in the game. It shows how are you coming up with your numbers, and making sure that if there's maybe an appraisal that talks about if you want me to loan on the purchase price and the rehab. So if I was going to do that, I want to say, all right, let me get, maybe there's an appraisal or it's a really good detailed CMA, not one that I have to figure it out myself. And here's a whole bunch of comps, and it's just housing, it's lists of houses, which I'm not sure if they're all 2 bedrooms or 3 bedrooms or 5 bedrooms, the square footage. It's, if they're making me do the work, it's like, I'm not going to look at it. The after repair value. And that's why I always think having the backup is really key. And the more backup you have, the higher your chances of impressing a lender, and as it shows that the risk is reduced. I would say look at also the skin in the game. I get nervous when I see someone that they're asking for financing and there's like no skin in the game. But I have actually loaned to people that had no skin in the game because the deal itself was worth more than what they were asking for anyway at the end. So and it's rare. It's usually after I would loan at least once or at least twice. After that, like I may be less not rigid, but less. I have my requirements a little less on that and make it a little easier. But skin in the game is important, and that's where if you don't, you have to show something in there, because I'm going to be looking at that. God forbid if there's a change in the market and you can't sell it, or the appraisal and the after repair value comes in less. At least I see that before it hits my principal, there's your profit that I would see that would be absorbed, and also your skin in the game before it even hits the principal. So those are things that is going to be important. I would say get an appraisal to back up the current value and ARV detailed in the deal analyzer, as I mentioned. And sometimes when they don't have enough skin in the game, sometimes this is where you could possibly have a JV agreement. You could, and that I have done that several times where they needed some capital infusion that way. So I did have some equity play in there as well. So that's where there is different, that's about, and I'm going to talk in the further slides about establishing the relationships and making those relationships with people. Another thing is show you have their money well protected. Time and time again, a lot of borrowers, they're just looking at the money, but they're not seeing my perspective and also without me asking, I want them to know, I want them to show like, how is it protected? I want to make sure when they're preparing, again, a deal analyzer, I want to see a scope of work with pricing detail, because time and time again, they'll throw me a deal and then they'll say, oh, estimated repair cost is $80,000. I'm in the construction business, so I kind of know what the costs are. When I know it's like $120,000, not $80,000, $75,000, and they have no backup. It's premature, and right now, then at that point, it shows me that there's a lot of risk for me because they're not doing their due diligence on doing that. So, and also writing a scope of work, that's super, super key, is making sure that that scope of work and has some good pricing detail from qualified contractors, licensed qualified contractors. So those are things that I'll be looking for. Again, when I say me, but generally with other private lenders, the same thing. Alternative exit strategy. Say the market changes, they want to sell it, but we have to rent it for a while to see how that the exit strategy. So they may have to pay me off because it's not in their best interest to keep the loan out for me. So at that point, they're better off probably refinancing the finished product. The finished product, it could be a rental building. They can actually finish. They could rent it out and then at that point get financing and then cash me out on that. So but it'll be good to see it in a strategy. God forbid if that will also lessen my nervousness about it, especially like what Dave was mentioning. We're all thinking that there is going to be a correction, something in the market, and so I'm looking for more skin in the game. I'm going to be looking for also like exit strategies, just in case. And then also the other thing is I want to see is show successful projects. Have you done this before? And that's going to be critical, because if it's your first deal, then I'm not sure if I would be lending to you, or if someone else may lend, or they may be giving you very high interest rates, and then that may be adverse for the outcome of the return on investment goals. So, and this is where you may want to also get a JV with someone. You may find the deal, but JV with someone that is more experienced, that can actually help with getting that, showing that. So these are the kind of the chances, again, for providing, getting PL financing. Any questions?
Yeah, Frank. Well, let me throw one at you first off. The length of time. Now, you mentioned obviously you're lending to somebody who's doing rehab, because then it would get to a point where your loan would probably be too costly for somebody who is going to their backup strategy and going to rent the property. So when they're doing that proposal for you, do you project out any certain length of time, like 2 years, 3 years, 1 year?
So I would look at, looking at the deal analyzer, I look at, say if it was I like a year, at least a year loan, but I know rehab, sometimes it's a rehab could be, I look at 6-month minimum interest, even though it may take less than that, but I look at 6-month minimum interest. But usually with rehabs, it could be like 6-7 months by the time they sell it. And then sometimes it's add a level projects, finance, and then that'll be over a year. But say a year and a half, sometimes you see 2 years. Sometimes it has been up to that, but there's a point where, I would then start when it's finished. If they finish it, as soon as they finish and it's not selling, or the market's changing, at that point, I would definitely start suggesting that they would get some long-term financing, so they could actually pay.
But their projection though only has to go at roughly a year for your particular.
I would say, I would say for up to like a year and a half, I would say, but I'm open to, I have money that's out there for 5 years.
Right.
Um,
Okay.
it goes out there. So it depends on the investment. But for people, I think on this call that I think do more rehabs or add levels, I would find, to me, having my money out there, because I always want to have, as a private lender, you always, once you get your money back, you want to send it back out because it's not making money. So you
Right.
want to go back out. So you just want to make sure that it's out there for a long time and it's not at risk of you losing it because it is the project is idle, it's not going anywhere. As long as it's this, there's things go in the pipeline.
Okay.
Had
What Frank, I'm sorry. What Frank mentioned now, guys, about that having some kind of analyzer, remember, that was one of the people we talked about before. That in effect is what leverage software does. It does a property analysis. So it's not only for a bank, but also for somebody like Frank. You could show him the numbers, how the project will work. So, go on their site and learn more about it.
Yeah, no, that's really good. And seeing it's from something like that, because especially when it has a breakdown of like the number of bedrooms, the baths,
Right.
the size of the yard, making sure, because some people, they give you comps and it's like, and they say, yeah, these comps of houses that are, they're 500 square feet larger, which makes a big difference. And they're on ones, they're your project on a main street, these are on cul-de-sacs. It's a different, so you have to make those adjustments when you do the, that's why sometimes an appraiser, having an appraiser is good. Or if you can work with those type of systems and adjust it, that would impress me if I saw those adjustments made from comparables to the subject property.
Okay. This is a couple questions here from Steve. Let me start with the second one first, because I think it would make more sense. Is there generally a private lender preference towards flips versus buy and hold investments?
No, I would say, well, actually, it's to me, I don't have a preference, because buy and hold, the only thing is, when I'm going to say buy and hold, you're going to buy, renovate, and stabilize the asset, and then probably cash me out by refinancing.
Right, because the interest rate to cash out would be lower for the person.
Yeah, it doesn't. Right
That's
now,
what you got to keep in mind, guys.
yeah, because the banks, because a lot of times you're going to go in, you're not going to have your cash flow,
Yeah.
and so you're going to need some to purchase it, to rehab it, and then once it's rehabbed, and you get the COO, and then at that point you can start leasing it out. After and that's what I want to see in the deal analyzer, like your projections and and understanding the absorption rate in the market, and then at that point, after a certain point, those will go out a little longer because it sometimes takes a while, especially if it's a larger project, but it's at least it's factored in there. So I want to see that the borrower is going to be making money. So we all win. It has to be a win-win for everybody.
Right.
And
Yeah,
then,
Steve's other question, I'm going to hold off again because I think you may be getting it to it later, so it wouldn't make sense to go out of order. But we do have a couple more questions. Do you have a deal analyzer that you provide your borrower?
No, but I would give I don't have one, but if they need one, I would send that to them. But if they don't have, like if they're asking me for it, I would give it to them. But then at that point, I'm like, they're probably
They've told you that, right?
Yeah, they probably don't have. I
Put
don't.
a skin in the game. You've got it, gang. You've got to let this is what you need to be doing the homework before you go to Frank.
Yeah, I would do it, but and then I would turn into a teacher, and then I probably wouldn't want to feel comfortable giving my $1,000 or $100,000 to them, whatever they need.
Right. Okay, we have. Would you or any other private lenders consider a negative cash flow deal for tax benefits at 50% of the appreciation somewhere down the line when sold? So an equity participation type situation with a negative.
If it's long term, yeah, because I've done. I actually know I haven't, but I've invested in deals where it's the first couple of years are they're much lower returns that I look for, and hey, I'll just let you know some of the returns I generally look for me to get my money out of the market and get into this is I'm looking at least anywhere from like 9 to 11%. That's what I look at. I don't really charge points. And so I'm looking at it that way. So when that question, sometimes I've actually worked on deals where it was like 2-3% initially until it ramped up. And then all of a sudden it ramped up to 12-15% in like later years. And the average like rate of return, internal rate of return, then it went to like 12%, 15%, whatever it was.
Yeah. I would look at that, Alan, just so you know, too, as if the negative cash flow, if it's on a short enough term, number one, and number two, it's doing something very unique because I know that area is gentrifying rapidly, or I'm getting negative cash flow because I'm really amortizing the heck out of whatever loan is on the property. And if I had to bring in a partner, I may say, okay, look, for the first, you're putting up the money for the rehab, and we're not going to make money much, but in the next 5 years, we're going to pay off 50% of the loan. And in that case, that might be a very attractive deal for the right person who needs tax shelter.
Yeah.
But again, it has to be a certain situation where it would make sense. BRRR method, do you think it's wise to invest in with the CARES Act in place? Do you know what BRRR method is? I'm not even sure.
No.
Okay, Michael, can you clarify BRRR method? Is that some kind of,
Dave, that's
Yeah.
it's known as the Burr method.
oh, here you go. Anthony, talk to us.
It's buy, rehab,
Oh,
refi, repeat.
oh, okay. Rinse and repeat type thing. Okay,
Right. So it's you buy, you rehab, you
Rent.
refi, and you repeat.
Okay.
It's called Burr.
okay. And then with the CARES Act, would you do that?
Well, it depends. Yeah, I don't know. It depends how it depends on probably why you're buying it, right? Because it's definitely if you have tenants, if your outcome, I'm just thinking of your outcome, if you're not.
First thing to do, gang, if you're going to be renting it, you pick your tenants carefully,
Yeah.
because whether you have a CARES Act or not, if you pick the wrong person, you're going to have trouble. So that is, to me, the most important part is picking the right employee who is your tenant.
Yeah. And I would definitely like it. If I was going to invest in something like that, it has to be vacant. So like Dave said, I could pick
You pick them, right?
pick the tenants to be more, it's,
Right.
and then also, you could probably get the property at a more preferred rate, because with the deferment of, with rent, or not or the forbearances that are out there, so a lot of landlords are saying, hey, this is not for me. It's supposed to be some type of income. I'm supposed to be receiving it, and it's more of a headache. I want to get out. And so I would be expecting some type of a discount. So if I looked at a deal analyzer on that, I'll be looking at some type of a discount, especially in an area that maybe have a high chance of forbearance tenants or something like that.
I feel old with all these acronyms that I no longer even know
Yeah.
anymore.
But it's funny when I worked, and when I was working with Wien and Malcolm at the in the Columbus Circle area in New York, that's what the owners did. It was the commercial buildings were so large that you can only renovate certain at a time, and it was not you buy, you just renovate and release and then refinance and then roll back into the property because it was a big property.
Yeah, I'll throw my 2 cents in, Michael. Yeah, it's always a great strategy. Buy, rehab, refi, repeat, as long as it's the right property and you're putting the right tenant in. And again, you want to make sure, in other words, if I personally look at a property, if it's in a so-so area, but I'm getting a killer deal, I'm paying that property basically to fix up and sell. If it's in an area where I think I can attract a solid long-term tenant, then I would be more apt to do the buy, rehab, and possibly refi and hold on to that property. But if it's in a so-so area and you want to then do that while the market is good, that's when you get out of those areas.
Oh,
Alan wants, I'm sorry.
Just a note, and then something like that too, they would have to sell it to the private lender, sell it to me. Like, you have to think of it, and you have to be convincing that this may be a good investment for me, and
Right.
not make me question it like in that way, but you come up and like, would it make it, would I? And so I would definitely, because because everything that could be a bad situation could be turning really
Right.
good, however you position it.
If you see it being gentrified, but right, but if it looks like a war zone,
Yeah.
no serious seasoned investor or lender wants to rent or loan in any kind of war zone type situation. We've all been around the block on that. And, we have the scars to prove it. Alan wanted to know 9 to 11% interest or return on investment.
So I would be looking at that as interest,
Right.
and it would be interest.
Okay.
And so, and just like if I look at this, it's called, I look at it as because it's passive. So, and I would even, it depends on the deal. I would even do less at times, but it depends on the deal, how passive, how secure I feel. So the more secure I feel, the more, and the less I have to do it for it, then the interest rate can go down. And then that's passive. I compare that if I make active income, if I go into the investments and I have to then buy something and I have to actively rehab it myself and I have to do all that. So if I'm working on it, then like if I was going to be someone, I would be looking at a minimum like 16% return if I had to actively work on that. And that's how I come up with a passive rate.
Okay. He also wanted to know, can you tell us how often you've had to take back or foreclose on a property and why you had to foreclose?
Never. Never. And because I do my due diligence ahead, I always look at the property that I look at. It has to be, for me, somewhere where it's in, if I have to take it over, I can operate it, and then I could fulfill the goals of that project's, whatever the financial goals of that project is. But I did not have to do that.
Right. Okay. I have somebody who raised their hand. I'm trying to find them. Oh, give me a second here. Okay, Deborah. Hope I'm doing this right. Deborah, I'm trying, asked to unmute. Oh, she lowered her hand. Okay. Okay, Deborah, if you have a question you want to put in the chat, that would be great. Okay, that is it for now, Frank, on the questions.
Okay. Frozen. Okay.
Oh, we do have another one, minimum loan amount and maximum.
So let me go back. Minimum and, okay. So the minimum that I've lent out, I think, well, it was 60,000. And, I prefer bigger loans, and the maximum, I lent was, 500.
I'm sorry, how much?
500?
500,000. Okay.
Yeah.
How many states do you lend in, and do you have a license to lend in those states?
No license, and New Jersey, and yeah, it's just New Jersey right now.
If I have a hot deal in Arkansas, will you lend to me?
No,
Why not?
I don't know the market, and that's the problem. And that's
Right.
I just don't know
Hear
the
that?
market. Yeah,
Very important. You want people who know the market you're dealing in.
yeah. And I get deals all the time. People they send me these little houses, and they're like, "Oh my God, you can make amazing returns, like 21%." Like they make the 20. I'm tempted. I'm like, "Oh my God, it looks amazing." But
Never works out that way.
yeah, and it's like, God forbid, I look at it as if I have to go out there and I have to go to court, and I have to then I have to be the operator and then try to crank out some return on that. It's just too far. So and actually that's why I'm actually heading to Florida too, because of people have asked me to lend in Florida. I knew nothing about the Florida market, and so I'm learning about the Florida market now.
Right. That's why you've been hanging around down
Yeah, so I'll be down there in January.
there. How much skin in the game is enough to get you comfortable, and who services your notes?
So, okay, skin in the game, this day and age, because of I'm thinking it's, we're gonna be in some corrective mode, sometime next year. So I'm looking at least 20% skin in the game. In the past, I've went down to 0 to 5%. So, but now because I'm looking the way the market is, I would be looking at least 20%, and that could be flexible based on the deal. What was the other part of the question?
Okay, and who services your notes? Now, when you said 20%, we're not just talking about 20% equity in LTV situation. You actually mean 20% cash.
20% cash, yes. Yeah, exactly. 20% cash. If I see they're borrowing 20% from someone else, and that I get nervous. I want to see that some type of skin in the game.
And then who services your notes?
Servicing the loan, I would have my attorney that services, I would say, the loans. I always have my attorney review, actually run through everything. And at one time I didn't. I kind of did it myself, and that was crazy. But not crazy, but it's like it makes it so much easier. So, and especially with the attorney, because I do rehab, and so what I do. So a lot of times people want money for purchase and then rehab. And if it's, let's say if the house is 100,000, I give, so at closing, they get $100,000 and they may get a little bit more money for starting up. And then, and say if another 100,000 for rehab, that money goes with my attorney's escrow account. And then, so there's then there's a construction loan. And then as the work gets done, then my attorney, then at that point, money is then released in accordance with the draw schedule, and then proving that the work was actually done to show that the value of the home is incrementally increased. So if it's 100,000, and then by the time I put the next $20,000 in, the improvements that they put in have to at least, and I would see it because I'm a professional, that at least it's not the 20,000. So I always have my attorney involved with it.
Okay. Is the interest based on the investment risk and the sale loan amount, et cetera? In other words, do you adjust your interest rate depending on
Yes.
the risk you feel?
Yes. Yep. Yeah. And the person I'm lending it to. So it all depends, and I can change it. I've changed it before with people.
Do you ever lend with another person on a deal, and do you lend using a self-directed IRA?
Yes. And the only, yeah, I've done it with my business partner, and I had also, I lend from my, I lend out my cash on hand, and also I lend out using my IRA, a self-directed IRA.
Okay. The Michael, 20% cash, even if the ARV is confirmed at 6570. Yeah. That's really irrelevant. Frank wants to see cash in the game. He wants skin in the game, actual skin, because when you're buying the ARV 65 to 70, that's his cushion for safety. So he still wants to see that. Do you lend on purchasing notes? I guess, do you do a discounted note business? I guess is what he's asking. Okay.
No.
Yeah, that's a whole nother field. We're probably going to do a webinar on that in the near future on doing discounted paper.
Yeah, and for me, and that's like for me with why I lend, it's really for my retirement. So I don't rely on any of that income. I don't want it. For me, it's and that's what you'll see later in the presentation. But for me personally, I don't look for income. It just gets rolled back in, and that's it.
Okay, if they put 20% in cash in, do you require any cash in reserve? Do you look at that, or you, like you said before, you don't really care if the deal's good enough and they've got?
Yeah, the deal's good enough. I would just look at that skin in the game, and then the deal has to speak on its own, be on its own.
It goes back to what you said before, because they probably don't have anything else anyhow. So why would you be bothering to chase?
So that's why I want to see the cash in reserve.
That's good, and you want.
Yeah.
Okay. Okay, that's it for questions.
All right. Let me just move this out of the way so I can see. So what are private lenders looking for? All right. So again, you want to impress a private lender. So what are they looking for? You have to put yourself in their shoes. And so one of the things they're looking for is diversity. like myself, from traditional investments, it's really, it's good to have a well-diverse portfolio. You have your own real estate, you have notes out there, you have stocks, you have bonds, all the different things in there. You want that. So but the biggest thing is the diversity, but is the higher returns and wealth building. And that's one of the things that a lot of people feel that traditional investments don't do, is build enough wealth. And so in the long haul. And so it's the compounded interest. Again, what I do, it's like, I start out at 100,000, and then at the end of the year, it's 110,000. And then that 110, I put into the next loan. And then all of a sudden that turned into 125, and then 125, it keeps on building. And it builds quickly. And the thing is, you don't have to worry about the stock market roller coaster, because it's locked in with that amount. And also, and the fees are also, it's not deducted from it, because that's one thing I used to be always looking at looked at my portfolio, like, oh my God, are these fees I was paying? And so again, a lot of times the borrower pays the cost for providing the financing. So a lot of times it's not just the interest rate, but also the cost. And if I have wiring fees, my attorney may be looking at the documents as well. So and I give you what the estimated attorney fees would be, the wire fees would be, any administrative fees, that would be, if there's like, they're going to be sending a check to me overnight, like, or I have to send out something overnight. So those type of fees that the borrower would pay for, again, it's minuscule compared to what traditional financing is, or what their cost is. Those are things that, so the higher returns. So that's why, and then the other thing is the passiveness of it, because you don't really have to think about it. And when I say the passiveness, and that's why I have my attorney involved, because the attorney handles it. It's just easier. They see what's out there. They have my records, and it's better that way. And it's also, it's backed by real estate, which is key. It's tangible. It doesn't evaporate in thin air. Unlike a stock. And actually, I know what I'm investing in. Before I was investing in these mutual funds, these stocks, I'm like, I know nothing about these stocks. All I know, it's a gamble. I'm like throwing my money out there. Here's 20,000 for this one, 50,000, whatever, or $10,000. And then I knew nothing what I was investing in. At least with this, I see what I'm investing in. And I see, and it's God forbid something gets really bad with the economy, at least I have something. I have a piece of real estate that I have. And also what I'm looking for is want an experienced and risk-averse borrower. I don't want someone that's going to throw me a deal and it's riddled with a lot of risk for me. And so I want someone to think about me. And again, I borrowed money, so I always put myself, because I put myself in my own shoes. And so when I borrowed money, I always made it as a pleasant, great experience, and showing where their real estate is how their money is backed, and how it's protected. And that's why I always look for someone that's conscientious, that will always put my interest ahead of their own interest, because it's and care for my money, because it's hard-earned money. It's like I just didn't get this money out of it's the investor's hard-earned money, so you have to treat it really delicately. So and someone that respects that then earn my respect when I would provide the money. Any questions on this? All right.
I do not have a mortgage, though. I would like to know if any private lenders would be interested in partnering up for a nice return.
Well, you know what? Yes, I like something like that. Say, if someone doesn't have skin in the game, but if they want to use the collateral of another asset for a deal, I'm definitely open to that. It's so my investment's backed by the real estate.
So an equity participation type situation.
Yeah.
Okay.
Yeah. Definitely. And I've done that plenty of times. That's how some deals. Yeah. It depends on the deal. And it's up to the borrower to come up with those situations, not the lender. So you're gonna, the lender, and that's where joining Mira and maybe if that's why maybe having someone review it before it's presented to a lender is I think it's a good idea, because you don't want to put it in the laps of a lender, because if you're doing that, it's a kind of a turnoff right away, and they're not going to feel comfortable
Right.
giving you money.
Right.
You have to come up with solutions and not and have it double checked by others before you present it to a lender.
Okay, that's it on questions right now.
All right. So recommended private lender strategy tips. Okay. So one, okay, create. All right, this is how I kind of started, at least with some of when I determined I want to start even borrowing money too. But it's a two-way street actually, because also I'm always networking with other investors, and everyone has different needs at different times. So definitely create a list of potential private lenders, and that could be family, could be friends, could be a business associates. And when I say business associates, can you pass colleagues? If you know you left a job, or a lot of people left the job, they may have a 401k that that they could roll over to a self-directed IRA and loan that money out. Networking events like this one, definitely the Mira is definitely is a great way. Basically, all of my private lending came from the real estate clubs. That's how it really all started. And actually, it came from real estate clubs and business associates. That's for me. Yeah.
Building relationships.
Yeah, it's building those relationships. Yeah. So it's building those relationships. And so I started off, I definitely try to get, I don't have my family involved at all, because I just don't. And I really don't have my friends involved at all either. I keep them out of it. So I started from scratch. So I just go business associates and networking events. And then, but then this is the other people that I would say another big group is when you're going for, like, you go into you're meeting your doctors, and the doctor's like, what do you do for a living? Or your dentist. And they always have a lot of cash at hand, and they're always intrigued. They're entrepreneurs too, because you always want to, I think people that are entrepreneurial spirited would be open to this. And so people that are kind of open, have their own businesses, doctors, dentists, attorneys, they're in their own business. So they would be up to it. And then what I would do is you network with them, but after a while, you can't be on the phone with them all the time. You can't always be in there, texting them or anything, but you could do Facebook, LinkedIn. You could educate them. And so, but creating that list, but that's where sometimes you can meet them and meet people. Actually, say you have a deal and you have a really good deal, you could throw it out there on Facebook or LinkedIn, and you never know, people from your past come out and say, hey, I know you, you're a great person, and this sounds really good. Tell me more about it. So that's number one. Let me see the next. Why isn't this? Okay. So the other one, okay. Develop a relationship, like what Dave was mentioning. So that's what's really key. Let them know what you do. And when and that's through calling, email, the Facebook, LinkedIn, Instagram. Educate them on private lending and its benefits to them, because someone's not going to just lend right away. Like for me, I didn't put my money in a self-directed IRA right away. It took me a year before I did that, but it worked on me after a while, and I was missing on opportunities. And then I was more disgusted with my returns, and I said, I'm just doing it, because it is a pain in the butt to move money over, but once it's there, it's great when it starts working. So you actually, and you're developing a relationship, educating, and that's what you're going to be. You're becoming an educator, and by educating, it's going to actually help you learn it and understand it better too. So that's going to be really key. And then understanding their needs. Just don't think about your needs, and you have to actually have the different, based on different opportunities, you're gonna have different lenders, because everyone has different needs. Some of them have, like, they want supplemental income, and they want these monthly payments. So if you have a loan from once the loan is sent out, they want monthly payments. So if they want those monthly payments, you have to put that in the deal, or you have to make sure that if you have a deal that could support. I personally don't want that. I don't look for that. but I know a lot of people do. Some of it I look for retirement income, and most likely would be okay with deferment of interest payments. So that's something, know that. So when you, because when you can always have a bunch of private lenders, always keep tabs of what their interests are. And then maybe they would be open to equity share, like I would be. And then also understand if they would be okay with, a lot of times people prefer the first lien position, but maybe they'll be okay with a second or third. Me personally, I'm not interested in a second or third position. And if I am going to go to the second or third, I want to have it's going to be a much higher interest rate, and I have to understand also how my money is going to be backed, and making sure it is still supported with all those liens. It's rare. I think I did it only twice that I actually went to a second position. I had never been to a third, but people do it all the time. So understand their needs, and that's why it's important to have multiple lenders, because everyone has a different need. This is an example of me and my business partner. This is me marketing in Facebook, that we were looking for private finance. We were just getting into like, hey, we it's not good to always use our money all the time. Let's get other investors involved. So, and we were offering 8 to 10%. Of course, we're the borrower. We're going to want to keep the interest rates a little lower. But so, and this is us, and this is a unique opportunity. We bought this brother and sister. They they inherited a home, their mother's home, and we were buying it from them as investors. And then they were saying, and then we were like, what are you going to do with the money we're giving you? And they're like, we don't know. And they're like, do you want to make money? And so
the bank at 1%, or would
1%,
you?
that's what we're going to do. And they're like, oh, let's, we can lend it to us. And we gave them, I think we gave them 10%. We give you 10%. And they're like, that's amazing. And so they knew nothing about private lending. It was the first time ever, but we walked them through the whole process so they felt comfortable. And that's what's key for you guys.
Trust.
Doing this, you have to walk, unlike a bank is more savvy. This is the reverse. Private lenders aren't savvy people. So you have to be the more savvy one and educate them on this.
And you have to protect them. You make
Yeah.
sure you pay them. It is invaluable, that relationship.
Yep. You just don't, it was their mother's hard-earned money that had that house. And so
Right.
we had to walk them, and they didn't even ask for stuff. We threw things at them. They didn't know about recording it or putting money in escrow, all that other stuff. We told them how to stage it so they felt comfortable with it. They did not use an attorney. We used an attorney, but we wanted to make sure our attorney represented their needs as well. So it was a fair deal. So, and then you have to be the same way, especially if you're going to have people's hard-earned money. So that's what's really key. So this is kind of stuff that we did. And the lesson is you are the educator, not them, because a lot of times these people that are lending you money don't even know how to do it. They want to do it. They don't know how to do it. So you have to guide them how to do that and have it always in their best interest. So the other part is, so how much money is available? That's understand when you have your private lenders, what's available. Sometimes they don't have money. Everything's lent out already. So they say, oh, they may have I have $300,000 available. That's now. Next month, I may not have it. I may have 100,000, or I may have 50,000. I may have nothing available. So understand how much is available. And everyone has different times available at a time, because I hardly have money available. Now I have it more available because I think the market's going to change. So I have an unusually high amount in the bank.
So you've become more conservative about lending right now, which is
Yeah.
absolutely the right thing to do.
Yep. You can find out if people have equity lines of credit, because some people can lend against, they have lines of credits that they don't use, that say they may have like a 4% line of credit, and you could use their money and pay them 10%. So they're not even using their own money, and they can be making some money that way. Understanding what they have cash on hand, any sales proceeds that are coming due, like they may have this brother and sister, they had money they're coming in. And so oops. Yeah, so sales proceeds, a self-directed IRA, and understand if it's self-directed IRA, you don't have, private lenders could pay quickly, but also if it's self-directed IRA, then it has to be reviewed by the oh, I'm drawing a blank, not beneficiary, the custodial company that has to review and make sure it conforms with all of the federal guidelines of using self-directed IRAs.
Right.
So that's what's really key. And timing is everything. Amounts will vary. And like I said before, it's like that's why you have to have, if you're going to use private lenders and that's going to be your source of funding, make sure you have multiple ones in there because everyone has different, they may have it now, they may not have it later. Right. And it's vary. Number 5, presenting the opportunity. So again, presenting them the opportunity that meets their investment goals. If I'm looking for money, I'm looking for something that I need to get payments every month. I need to see my interest payments, and you're showing me a deal that doesn't have it. Don't waste. It's like that'll turn me off. I'm like, you know what I'm looking for, but just present it that meets it. You can always ask, but there's always your highest chances of getting someone to loan you money is to match them an opportunity that meets your investment goals. And then number 6 is protect their investments. That's a big thing. Show them how you're going to be protecting their investments. You have to be the one that's proactively doing that because they may think it, and then and if they don't feel that they're being handled or they don't feel like their money is being handled well, they'll just say, no, another time. They'll just pass it by. They'll just politely bow out. So show them how it's going to be is protected, and show them the details of the cushion from what they're investing. So show them the cushion. That's what's really key. Is always articulate that cushion from what they're investing. And when I used to present the cushion, when I'm on the other side, I'm always presenting, hey, this is my projected profit. That's the cushion. And this is my skin in the game. That's the cushion before it even hits what your principal and your interest. So always show them, articulate that. Don't let them try to find it or look for it. Just show them. So that would be really key. Any questions?
Yeah. What are different ways to structure a private lender agreement with pros and cons? I think it kind of goes into everything you've mentioned. In other words, every agreement is going to be somewhat different because every deal will be unique. For instance, is it an equity participation deal? Is it an interest-only deal? The pros and cons, I think you kind of just mentioned with protect the investment, and anything else you'd like to add?
Yeah, I'll go into some of how the investment is protected later in the presentation, maybe.
Okay.
But
just so you know, we're running.
Oh yeah, what time is it? Oh, we gotta yeah. So biggest thing is in the agreement has to be, I look at it this way, it has to be a win-win for everybody. It can't be one-sided. So it has to be a balanced contract. If I would not go in a deal, if it's just one-sided, if it's just benefiting me, then I would say, don't do the deal. It's not worth it.
Exactly. You see somebody who's not going to make a profit, you let them know that.
Yeah. And me as being an experienced investor too and contractor, I would either, I would help them at least. That's where I would come to play. That's just, but not everyone's like that too. So,
right.
So next, forms, which, let me see, what is this? Oh yeah, forms by which the private lenders want their loans secured by. So again, always impress, be proactive and advise how you would lead and execute this task professionally and timely. Don't let them lead it because remember, they're not the professionals. Unlike it's a bank, when you're dealing with banks, they're gonna lead. In this case, you're gonna lead. You lead, and especially if you want repeat business. So highly recommend having an attorney involved, reviewing titles, preparing the notes, and all these other things. So number 1 is the notes. And everyone knows it's the contract for the loan. So it specifies the names, the principals, the balance, the interest rate, the start date, terms, due dates, if there's points, all that stuff. That's the note. So that's the contract of the loan. Then you have the mortgage. That is what gets recorded. And you want to make sure that's recorded timely, and show it to them that it's recorded. And that's why they get the attorney involved, because they'll do it faster than me. You're collateralizing the note with the pledge of real estate. So that's what's really key. You want to also see the forms, clean title search. So you want you, the borrower, do a title search that shows that there's no liens against the property that can adversely impact the collateralized loan. Also, if you're doing a draw, say if it's a rehab loan and you're going to be doing draw requests, each time you do a draw request, you'll probably have to present a title search showing that there's no new liens on the property in order to get that. And that's something that you would do proactively. They may not ask, but you tell them you're doing this to protect their money and protect that there's no other liens. Like the real estate taxes are paid, all that stuff. You want to make sure of that. And the appraisal is another thing, a third-party validation of the current value and the after repair value. It's used to that's used for the collateralization of the loan. So, and they confirm it's third party, so they're going to confirm the zoning. So you can say if you're rehabbing a 2-family, and then all of a sudden you find out that, oh, it's not a 2-family, it's a single family home. So you want to make sure things like that, you want proof, show proof of that to the show it to the lender. Hey, Dave, how much time do we have? What time do we have to go into?
Normally we're done around 8:15 to 8:30.
Oh, I'm sorry. Let me speed it up.
That's okay.
All right. So I'm almost finished. So keeping the relationship is critical if you want repeat business. And so time and time again, I've seen you want to have periodic project updates. Don't go dark on them. That's what's key. I don't like when I have to reach out and say, hey, how's the project coming along? And that's what, so always be proactive. I did it a lot of times on Facebook. So if a project, I would go on Facebook and they're like, it was very efficient for me, because I used to, all the people, if I borrowed from, I used to keep a project. I used to just do it on Facebook. It was just easier that way. Or I did a video and I used to send it to them. So, so always keep an update on the projects. Also send accurate and updated draw schedules and title searches, because that's one thing I don't want to, I would double check as a lender, but I want someone to do the administrative work for me. So I don't want to burn calories with you. So do it. So send the update. If there's draws, do it. And are the attorney checks that anyway? But at least most of the heavy work is done already. So do that. Provide guidance and instructions when the loan will be paid. Another thing is, payoff calculation with daily rate for lender approval. So even though usually the lender will say, all right, you're going to be paying off the loan, I'm going to send it to you. But I think it's always good if you would flip it and also provide it. And this is what I see, what my costs are going to be. Do you agree with it? And you're like, yes, I agree with it. At least you took the burden off the lender. So that's something it's little things that I like. And then, because that's, believe it or not, I hate doing that. Oh my God, the loan is due. And like, I got to put that loan calculation together. It's the worst. If someone else does it and I just see it, it's the best. And then, what's this? I can't see. A follow up to ensure the lender was paid and thank them for their trust in you. That's a big thing. Thank them. Time and time again, it's amazing how I've seen myself, I lent money and I'm chasing my money at the end. I'm like following up with the attorney. I'm doing this and that. What's going on? Like, no one's getting back to me. It's like, this is crazy. And then after that, I'm like, do I really want to lend to this person anymore? And so always be proactive, guide them through what that step is. So, and that would be, because after it's the payoff calculation, then you're going to have the discharge. You're going to have the attorney or someone fill that out. That's going to be used to release the lien, the mortgage that's recorded. So that's that. And then you can do it again.
Rinse and repeat.
Yep.
Okay. Let's see if we have any more. I don't think we have any other questions, guys. Last shot of questions. I think what you should get from this is the most important thing Frank was trying to build your relationship, let people know what the project is, do your homework beforehand, and make sure you stay in touch. So Frank, if somebody would like to reach you, how would they do so, sir?
So you can reach me at, I just put it up right now, frankmulata@gmail.com. They could go to my realtor page. I have my Frank Mulata realtor, investor, contractor, and they can reach me there on Facebook and also on LinkedIn.
Right. Okay, yeah, Frank, guys, Frank's a wealth of information, so make sure you take down his contact info and you'll be the better for it.
Yep.
And Frank, I want to thank you very much.